Hello and welcome to Forex.Academy. Of course, I am your host, Robert Blackwell, and I will be able to walk you through today's daily educational video. Before we do move into the webinar, please consult our disclaimer. Of course, there is risk inherent when trading the financial markets. On the content of this particular webinar, we will discuss trading bond markets. So trading the debt markets, and particularly focused not on corporate bonds, but on government bonds. So let's delve into the bond markets themselves. A bond is essentially a way for a company or government to raise capital to meet their financial obligations or to finance projects. An investor can participate in lending to the institution with the objective of making a return from interest. Okay, so this interest payment is known as a coupon and is usually presented as a level of percentage. So 3% coupon, for example, would deliver a 3% interest payment over the duration of that bond. The issuer of the bond will effectively sell debt to the financial markets, creating new financial liabilities on the balance sheet in exchange for fresh capital. The level of interest investors will receive is a function of perceived risk, i.e. the possibility of default and the time of maturity of the bond. So if we think simply trading the bond markets, they are effectively lending debt. So basically, if you're looking for a level of safe capital, you can actually invest in the bond, of course, over the duration of that bond, whether it's 2-year, 5-year, or 10-year with a return. Think of it quite simply. If you're lending money to a friend, of course, you're going to expect a return for lending perhaps 500 euros to a friend over the duration of a certain time period. The time that you're going to lend, or the duration of that time, is going to reflect the amount of interest that you're able to place on that time. And of course, the risk effect of the default, the inability to your friend to pay back the full principal of the amount that you loan to him, is of course a perception of perceived risk, and will of course price the interest itself. Corporate bonds are a good alternative for firms that want to raise capital without diluting or reducing their percentage ownership of the company through selling equity and new shares issuance. So you can of course trade corporate bonds in the financial markets and government bonds. What we will focus on particularly as financial traders, we can access leverage to trade the price of government bonds. So how can we trade these government bonds? Well, government debt markets are of particular importance to fiscal policy and in running the economy. Traditionally, they are regarded as the safest long-term investment, as the government is of course considered to be very likely a partner to repay a loan to its creditors. Okay, so if you're going to invest in a government bond, you're effectively buying or purchasing an issuance from the government. The government is looking for some investment, decides to issue a bond over perhaps a 5-year period with an interest payment. They are, of course, very likely to pay that back over that duration. So the facility of the contract for difference allows us to trade a government bond's price in relation to its yield, and its yield is simply the duration of interest payments over the duration of the bond itself, or the rate of return of the bond over the time of that bond. Both the bond interest rate and level of default risk will reflect how the market then prices the bond. So let's look at one example here, and here in front we have of course a 10-year treasury bond here from the US government. Now it's just like no other market, it trades very much in relation to price, and what we can assess is to trade it on a technical basis. Of course, we don't necessarily need to know what level the price or yield the bond is being priced at now. Just to give you a bit of insight here, at this level right now, we are effectively at 3%. So that means the government is providing a return on capital that it is issuing in the debt markets at 3%. So that is very attractive. We can see that there is a long-term trend to the downside. So if we just use a hypothetical example, up here we might be at 2%, and furthermore up here we may be at 1%. So again, when the bond is at this level here, it may not be as attractive for investors to actually invest in the bond until it actually trades down to a certain level of 3%, when that becomes an attractive investment. Because if you're going to invest in a 10-year bond, you of course would prefer to have an interest rate payment of 3% over 1%. So that is how we can see these prices start to factor in, and of course that is an attractive investment in the investment community over the duration of 10 years. More specifically, what we can look to do is simply trade this in relation to the price. So again, What we have here is technical analysis that we can see there's a very long-term trend in this market, and again we can simply look to speculate that interest rates are going to increase over the 2018 and moving on through 2019. We see the health of growth in the US economy. As interest rates increase in the economy, we actually see this move down over the long run. So we can aim to speculate fundamentally as well as technically that this price is going to decrease over the long term and effectively trade as such. So again, in trading bonds, we'll look at two particular bond markets here. We have two of the most popular bonds to trade are, of course, the US T-note or the 10-year Treasury bond and the German 10-year bond. They are currently priced according to their respective yield, which reflects the interest an investor will make over the duration of the bond. So here we can see that the 10-year bond in the US is delivering a return of 2.97, and the German 10-year bond is at 0.58. So not as attractive, and of course that will relate to having a much higher price within the market. As that price starts to trade down, well, the inverse relationship between price and yield will deliver a higher return on the German 10-year bond. So in terms of pricing these markets, the issuance of government debt is to fulfill borrowing requirements. The government must borrow to run national affairs. So just like any other institution, it needs to borrow to actually run some affairs. In effect, governments then sell or issue government debt over fixed term periods. So we have 2-year bonds, 5-year bonds, 10-year bonds, and even 30-year bonds. Bonds are auctioned at market to determine price, and this price reflects the economic outlook and stability of each region as a function of perceived risk. When there is greater risk and more uncertainty that a region will not be able to repay its debt, the market will, of course, demand a higher rate of return, i.e. the yield on debt issuance. So one example of this perhaps may be if we think to a few years back where Greece was offering a rate of return of 25 upwards to 30% on their 10-year bond. That reflects a very, very high rate of return for investing in Greece. But of course, given they had a high level of default risk, meaning they could not maybe pay back the loans on their balance sheet in terms of the bond markets, that priced into the yield. So they had to actually offer an attractive investment with a very high rate of return on their debt. So that's a brief discussion there of the bond markets. Thank you for joining us here at Forex.Academy. We'll see you next time. Bye for now.